Well, it's been a quite challenging and interesting period because we were used to a quite stable environment with low inflation, stable economic growth, and stable markets. We had some risk-on, risk-off movements, but the framework was somewhat stable. But after 2020, after COVID, after all the economic stimulus, everything changed, and many models by central banks and economists stopped working, and everyone was guessing what would be the economic environment after that. And that was difficult to predict, but at the same time gives for active managers the opportunity to create alpha and overperform. First of all, being flexible and active. For example, in 2022, we were fully hedged on duration risk because we always thought that negative interest rates in Europe were unsustainable because they didn't work to stimulate the economy in the right way. So we thought that sooner or later that would end, and it ended in 2022 for many reasons, but we were ready to exploit that. And at the same time, the year later, 2023, the bond market was much more interesting at that point because our interest rates went up and credit spreads also were wider because of fears of recessions and slowdown in global growth. So we completely changed our allocation and we increased both duration and credit risk. So we gave our investors this asymmetry to be defensive in 2022 and more aggressive in 2023, where value was there. It's very important because we are a small boutique, a small banking boutique in Lugano, and a family-owned business. So it's important for us to show we can compete at the highest level with big players.